Iran war. What will happen to the dollar? Stocks, oil, precious metals, and more. We're going to go over data and draw some conclusions so you can be better prepared. And we're going to do this in one simple, fast step. Let's dive right in. First, we're going to look at stocks. Let's go to the chart editor. First, let's look at how geopolitical events affect the stock market over the short term. When the news hits the market, it usually goes down, but not by a lot. The total drawdown is a little more severe, but the recovery happens relatively quickly, especially since 1990. Over the long term, it doesn't look like wars have much of an effect on the stock market as a whole. During the Gulf War, which is probably most applicable to the current potential situation in Iran, large caps went up by 11.7. Compare that to a long-term historical average of 10. But small caps did get hurt quite a bit, down by 1.2% compared to a long-term average of 11.6. The broad conclusions that I would draw from this is short-term, the market can go down, but long-term, there's probably very little effect. Next, we'll go to the price of oil. We've got some really cool insights that I found short-term and long-term. Before we get into that, let's go to the chart. For oil, I want to specifically look at the Gulf War, which was from August 1990 to February 1991, and the Iraq War, which the invasion only lasted a couple months, March 2003 to April 2003. For the Gulf War, the price leading up to the war, and just as it started, really spiked. But then once things calmed down and the market absorbed it, oil went right back down to where it was before. Looking at the Iraq War, prices spiked as well for the buildup, but then sharply sold off. So again, it was buy the rumor, sell the fact. Today, things have changed. The United States is the #1 producer of oil in the entire world. So experts believe that if we get into an altercation with Iran, prices should be far more stable than they were during the Gulf War or the Iraq War. But most of that production is coming from shale, and there's a problem with that. Shale is very capital intensive, and most of the investors actually lost money. And those shale reserves are depleted very quickly, much faster than normal oil reserves. So during the short term, we may see a buffer, but over the long term, this could result in prices going much, much higher, especially if interest rates go up. There's going to be a lot less capital available for money-losing investments. As we know, the real economy is dependent on the financial economy, and the financial economy is dependent on interest rates. So now more than ever, it's crucial that we understand where rates have gone in the past. Before, during, and after the Gulf War, rates really dropped dramatically, but it could have been more so because of the recession. And of course, now Greenspan was at the point in his career when he was dropping rates every time he saw his shadow. So take this with a grain of salt. But interest rates dropped for a while. It looks like they dropped again and then started to go back up. Moving on to the 10-year, it looks like rates dropped as well, but dropped a lot less, which is interesting. And I think we can draw some important conclusions from that. So in the event of an Iran war, interest rates will most likely go down, especially today, because the whole entire financial system depends on low interest rates. But we also could see a steepening of the yield curve, but not the normal way, not in the sense that interest rates on the long end would go up, but interest rates on the short end might go down, and on the long end they might go down, but they might go down just a little less. To illustrate this, I've got a little yield curve right here. Interest rates, or the Fed funds rate, went from 2% to 0. And in this example, the 10-year went from 4% to 3%. So although those rates on the long end did go down, that yield curve still went up and steepened more dramatically. Why does this matter? Well, for the banks, first and foremost, this could bail them out. Because remember, banks make money by borrowing short and lending long. So if they have a flat yield curve or an inverted yield curve, it's almost impossible for retail banks to actually make a profit. And our banking system, the whole world's banking system, is so fragile right now that this actually could do them a favor. Now, don't get me wrong. I don't like banks. I don't like bank stocks here. And there's not enough data to come to this conclusion. I just think that after looking at those charts, it's an interesting observation and you should give it some food for thought. I also want to point out that if the yield curve were to steepen by the long end going up, the interest rates going up on the 10-year and the 30-year, that could have a long-term effect on the price of oil, like we said earlier. So you may be asking, okay, George, well, what could make that happen? What could make the long end of the yield curve go up? Well, that's a perfect segue into inflation. In the past, small or medium moves in inflation wasn't that big of a deal, but now our economy has so much systemic risk because of the financialization and the fragility of the world economy that we've got to be cognizant of this at all times. So understanding what inflation is done in the past so we can hopefully understand what it most likely will do in the future is the best way that you can be fully prepared. Inflation during the Gulf War was extremely high, over 6%. But during the Iraq War, it was much more tame. But it did significantly spike from 2003 going into 2004. If we broaden our analysis from 1926 to 2013, inflation went up on average of 3% per year. Granted, these are the government's numbers, so take them with a grain of salt. But during all wars, inflation went up by 4.4%. World War II, 5.2%, Korean War, 3.8%, Vietnam, 4.1%, and the Gulf War, 4.7%. So the inflation during all the wars was much higher than the typical rate of inflation. Historically, inflation does run hot, which could impact interest rates, making them go up and steepening that yield curve. But I want to point out here a very important lesson. When we think about the economy, we have to realize that it's a complex system, just like nature. And what I mean by that are there are countless cross currents that are at play all the time affecting one another. So just because the price, or in this case inflation, goes up or down, it doesn't necessarily mean that it's going up or down because of the reasons that you attach to that event. Let me give you an example. Let's just use inflation. Well, that could go up because velocity, increased money supply, psychology, war, oil. So if we're looking at this and coming to the conclusion that inflation went up as a result of war, well, maybe, maybe not. Maybe in that small data set, it could have gone up each time because of psychology or psychology shifting, or maybe the velocity increased, or maybe the price of oil went up because of the war, or maybe it was a combination of everything. You really can't sit back and say, unless you have a huge data set, that something happened definitively because of this reason. In my opinion, if you take that humility and that wisdom and apply it to yourself and your investment strategy, you're going to see things far more clearly, and in the long run, you're going to be much better off. Now we get to the fun stuff. What happened to the United States dollar? Let's go back and check it out. From the start of the Gulf War till the end of the Gulf War, the dollar went from 90 on the dollar index all the way down to 87, which doesn't seem like much, but that is a substantial move in just a matter of a few months. In the Iraq War, during that same time frame, it goes from 107 all the way down to 102. In the last two Middle East wars, we know the dollar dropped, and I think that's an understatement. It completely tanked. But that brings us to the point of the cross currents that we were saying earlier before. And I want to harp on this a little bit more because it's vitally important you understand this. Editor, let's go right back to that same chart. If we go back to 1985, we see a distinct downward trend in the dollar. So most likely the drop in the dollar during the Gulf War was just a part of this trend. Same thing applies to the Iraq War. From 2002 to the middle of 2008, the dollar index went from 113 all the way down to 84. So again, the downward move in the dollar during that war was most likely part of just a bigger trend. Now, the moment you have all been waiting for. What happened to precious metals? Be prepared for some shocking insights. First of all, gold. It did get a bump at the beginning of the Gulf War, but then fizzled out. During the Iraq War, it also spiked up, but it looks like this could have been a move in a giant bull market ranging from 2000 all the way up to the end of 2011. Moving on to silver, didn't do much during the Gulf War, and during the Iraq War also didn't do much. So what were those shocking insights I was talking about? Well, to be honest with you, when I looked at the price of gold and silver during war times, there wasn't too much shocking about that. But what was interesting is when I started looking at the price at the top of the last bull market. Gold from the bottom in 2000 all the way to the top rose about 9 times, but silver went up 11 times. And if you look at the price of silver as a percentage of the price of gold, at the top of that bull market, the silver price was 2.5%. If you look at the averages from what I saw on that chart, it looks like silver is typically between 1.5% and 2% of the price of gold. Where is it today? And just to be clear, today is January 9th, 2020. It's only 1.1% of the price of gold. So my point is that silver right now is really, really cheap. So would I invest in silver today? To answer that question, let's take a look at the way I set up my portfolio. And this isn't investment advice. This is just the way I like to do things. This excludes the cash that I have sitting on the sidelines for dry powder to take advantage of some opportunities if the market were to crash. But 80% of my portfolio I like to have in investments. I define that as assets that pay me to own them. 10% insurance. For me, that's just physical gold. 10% in speculation, and this means I'm betting something exclusively because I think the price is going to go up. Silver could be a good candidate for this because it's so cheap, historically speaking. But I want to be clear, I only see it as a speculation. And so many people have said, George, is this going to be the roaring 20s, just like it was in the 1900s? And I'm not too sure about that. But one thing I'm more confident about is that it's probably going to be a roaring bull market in not only gold, but silver as well. Over the holidays, we've had a lot of you supporting the channel through PayPal. We're extremely appreciative, and the whole team would like to thank each and every one of you.
I'm Danny, I'm an editor, and I would like to thank Robin F. Miller, Larry Altinger, Jeff MacArthur, Sandra Discombe, and David Calvin.
I'm Catherine, and I would like to thank Dana Bates, Paul Gates, David Smith, Corey Trees, and Curtis Helms.
My name is Thomas. I'm the camera guy and an editor as well. And I would like to thank Arthur Ternosky, Tony Lauerman, Sabir Semerkant, Pedro Jose Branco, and Forrest Bale.
My name is Estefania. I'm another editor, and I would like to thank Neil Buckendall, Sterling Mesa, Gretchen Ram, Christian Pusateri, and Mohamed Al-Fati.
I'm Sebastian. I would like to thank Gregory Cornett, David Long, Homegrown Mandolins, Mobile Locksmiths Perth, and Tienda Fotovoltaica.
If you would like to support the channel as well, we'll put a PayPal link in the description below.
So for more content
That will help you build wealth
And thrive.
In a world of out of control central banks.
And big governments.
Check out this playlist right here, and I will see you on the next video.